Hello, everyone. Trader Razor here from Conquer Wall Street. It's January 17th, and I am thrilled to share my long term technical analysis of the major stock market indexes, stock sectors, Bitcoin, and a few of our trading systems built for busy investors that work during normal trading hours but want to profit from easy to follow end of day trading strategies. Now, I know some of you might be seasoned investors while others are just starting out, and that's perfectly okay. If you have any questions at all, don't hesitate to reach out to our support team at conquerwallstreet.com. We're here to help you navigate this wild world of investing. Remember, this analysis is just one more tool in your toolkit to help you gain insights into the markets. And let's start off today. We were talking a lot in our last market analysis about this head and shoulders formation that was forming in the S&P 500. So you see your left shoulder, your head, and your right shoulder. And this had a measured move if it broke through that neckline down to about that 560 level on the S&P 500 or the 200-day moving average, which kind of coincides with that area. And what we see is just before the CPI report came out, we had a break of that neckline and it regained that neckline on the close. But then the very next day, we got the CPI report just after that, one day after that, and we got that big gap up because we got better than expected numbers. The market was forecasting a 0.3% increase in consumer prices, and we actually got a 0.2% increase. And here's the result of that. We've been watching the 10-year Treasury yields as a sign of whether or not inflation is in control. And as 10-year yields have been increasing, we've seen a little bit of a correction in a lot of the stock market and uncertainty in the stock market. And what happened? So we got the CPI report on Wednesday, and the yields dropped on the 10-year Treasury, and the S&P 500 gapped up, and we regained that neckline I showed you on the previous slide. So did we get a failure in that head and shoulders pattern? To be determined. We can get an extension of this right shoulder. We haven't gotten enough upward momentum to say that this pattern has failed. So we still could be putting in a little bit longer right shoulder. We need to watch these 10-year yields to see if we get continued downside. So the other thing we have to consider is when we're watching these 10-year yields, the big monkey or 800-pound gorilla that's kind of hanging onto the stock market right now is inflation coming back? And the yields since September, the 10-year Treasury yield has just been on an uptrend. And we see this pivot low in September. We see another pivot high in November, and this pivot making a higher low in December. And then here in January of 2025, we have this higher pivot up nearing 5% in the yield. Well, we do have a pullback, but we need to see lower highs and lower lows to really know that this inflation picture, at least the way the market is perceiving it, is under control and it is behind us. But right now, we don't see that from a longer term perspective. Then we have stocks. Are they being protected from a deep correction by President Trump or a Trump pump based on some sort of hope that President Trump is going to come in with all these magical ideas and fix all the little things that are broken? Well, what's the Trump pump about? What are people believing that President Trump is going to do when he comes in? Well, according to Yahoo Finance, there's a big hope and belief that there's going to be deregulation for a lot of the banks, that he's also going to be bringing in some cryptocurrency friendly policies. And one of those big things that we've been speculating on is a strategic Bitcoin reserve. And that might be one of the really big reasons why we're seeing this great big pump in Bitcoin over the last few days. As of right now, it's about 105,000 on Bitcoin, and it's broken through that 100,000 level for about the fifth or sixth time. I don't quite recall off the top of my head. But if Trump would push for a Bitcoin strategic reserve and there be massive buying by the government, that would put a bit of a floor, I believe, in the price of Bitcoin. And the third thing that's adding to the Trump pump is the possibility of lower corporate taxes. A corporate tax cut would be beneficial for the earnings of companies. And as you already know, I've been talking a lot in these videos about stocks being overvalued and everything needs to go right for them to sustain the price to earnings multiples that they're currently trading at. So this all sounds good, but what could go wrong? And it's just that I was talking about valuation. We look here that the average price to earnings multiple for stocks in the S&P 500 index is currently around 30, and the historical average is around 20. I know I keep beating this drum, but when you have stocks priced this way, nothing can go wrong with the earnings picture, or you're going to see a massive correction if earnings expectations aren't met. So I would just say if something would go wrong, whether that's geopolitically or with inflation or higher interest rates to be expected, or even Federal Reserve rate increases, I would say watch out below in that type of a situation. That being said, there is some good news though, as we ride the wave of hope, is that fourth quarter earnings look really good according to our friends over at FactSet. In their latest report, according to FactSet, companies in the S&P 500 are reporting their highest year-over-year increase in earnings growth for the fourth quarter in the last 3 years. And what's really interesting about that is 9% of the companies have reported earnings so far. And of those 9% of the companies, 79% of them have reported earnings above their estimates, which is right in the area of normal. It's a little below some of the longer term average, but a little bit higher. It depends on what you're looking at exactly, but that's really good. And the other thing that shouldn't be a surprise to any of our members is that the financial sector have been reporting the largest increase in earnings. And the reason I say that is when we do our stock sector rankings for members, financials have been one of the top performers and the top ranked sectors in those reports for most of the year. So, Trump's first day, is he going to put forth an executive order to target Biden's cryptocurrency policies, possibly removing some of the regulations that President Biden has put in place? Well, this is possible, and this is another reason that you're seeing Bitcoin pumping. A lot of those insiders that know President Trump and have talked to him about his proposed plans, one of those plans is to overturn the SEC's Accounting Bulletin 121. This is important because that bulletin, that SEC bulletin, requires banks to classify cryptocurrency on their balance sheets as a liability. And by removing this, that should help banks out greatly. And the other thing we want to talk about is Bitcoin pumps, as a good CPI report on inflation fuels a risk on move in Bitcoin. And Bitcoin, as you know, it says in this article, is a little bit older article. It came out on Wednesday following the CPI report. But as you know, Bitcoin today is trading at about 105,000. We'll see where it closes. But that is very bullish, combined with the possibility of President Trump's deregulation and the strategic Bitcoin reserve. There's a lot of things going in favor of the price of Bitcoin being higher from this point forward. And this should be no surprise to our members of ConquerWallStreet.com. Our Trendmaster Pro trading system for the Bitcoin trading system, we've been in this trade for quite some time now. This system that we offer is an end-of-day system that's easy to follow. We send you email alerts after the stock market closes each and every day. And on our Bitcoin system, this system has been 62% profitable with a profit factor of 3.527 and an average winning trade of 43%. And you can see just what our members see here. We got long right about October the 15th in this system at a price right around $66,000. And what our system does, it takes profits incrementally along the way. We took some of our money off the table at a 10% profit target. We took a little bit more of our money off the table at a 15% profit target. And we took another portion of our initial capital off the table when we hit a 25% profit in Bitcoin. Now, ever since then, we've just been moving up and up with the remaining 50% of our original purchase from $66,000 in this trading system. So congratulations to all you members that got in when we sent that email alert out to your inbox. Okay, let's move forward to the analysis of the major stock market indexes for the week. First up, we have the monthly chart of the S&P 500. And as I've been pointing out for a number of weeks now, we are quite extended. When we look at this chart, first thing we notice is that in a healthy market, we have these regular pullbacks and touches to the 50-month moving average. You see that here in 2020. You see it again in 2023. You even see it back here in 2016 and 2019. We get extended, we come back, we touch the 50-month moving average, and we bounce off of it in a healthy market. Well, we have this cup and handle pattern that formed back here in 2022 to 2023. Little handle here. You can't really see it on the monthly chart, but it'll show up better on the weekly chart. And then we just broke out and we just really extended ourselves from the 50-month moving average, which is currently about $450 per share on the SPY ETF. And the only reason I bring this up is we do have some things that are concerning. One of those big things, as I mentioned earlier, was the valuation of stocks at this point. An incoming administration, there's some geopolitical risks. If something would go wrong and the market would correct, if inflation would take off, we should expect a pullback at least to the 450 level on this chart, and we would still be in a dominant long-term uptrend on a monthly time frame. So that's just something to keep under your hat and keep an eye out for. If you're bullish on these markets, you have to know if something doesn't go the way that people expect it to, what would a pullback look like on a long-term perspective? We see the same thing with QQQ, NASDAQ. Although we do have this nice tight trend line of touch points going back all the way into 2023, we haven't touched that trend line on this current pullback in the NASDAQ. And as a matter of fact, it's like we're starting to form a little bit of a hammer formation on the monthly chart. But here, the same thing, we're well extended from the 50-month moving average, and that sits about 375 on the Qs. Dow Jones Industrial Average hasn't had quite the big move as a lot of the other indexes, but this is your blue chip index, so it's a little bit more conservative. But you see it's holding in that nice tight channel that we have where it broke out from this 363 level going all the way back to 2022. We did remain in that. We had that big bearish candle just last month, and now we're forming a little bit of a hammer here in January, but remaining in this long-term uptrend. But like I said, should something go wrong, should it break out of this trend, the downside is right around this 360 level, a significant pullback in the Dow Jones Industrial Average. Here we have a weekly view of the SPY ETF. We see this nice little channel going up. And a pullback is remaining within that channel on the weekly time frame. This looks nice and bullish. Here you can see that cup and handle breakout I talked about earlier a little bit more clearly. Back in 2022, you have a little cup pattern and then a little bit of a handle here which broke out. Looks like a nice volume in October, and it's been nothing but up and away since October of 2023. Like I said, we do have the 50-week moving average below, and it wouldn't be inconceivable to see a little bit of a touch back to that 50-week moving average, and that would still keep us in a nice uptrend on a long-term perspective. QQQs, you see the same type of channel in the Qs, and it has those touch points going back and forth all the way back since 2023. The lower end of this upper trend line coincides with the 50-week moving average, which is nice, and it'll act as a double area of support. I would expect, unless something would significantly go wrong, that this trend should continue. Dow Jones Industrial Average, we see the same type of a channel. And here we have the SPY ETF. I like to point this out. I've been doing this for quite some time, a number of weeks now, is that the RSI on the weekly chart of the S&P 500, we have this divergence forming. And I mentioned a few weeks ago, we had that little bit of a rising wedge that you saw earlier. And I was talking about this divergence as it might be predicting a bit of a pullback coming in the not too distant future. Well, we got that. We got that over the last couple of weeks. We got this little bit of a pullback in the S&P 500, but it hasn't broken above this trend line yet. For me to get really bullish on the markets at this point from a longer term perspective, I'd like to see the RSI break above this trend line and make new all-time highs, taking out the 600 level on the SPY. QQQ, we see the same type of divergence, and we saw that same rising wedge which it broke down in. Now, is there more downside? Are we just going to come back up here and retest the highs on the Qs and then pull back again? That's possible. The RSI is indicating until we break this upper trend line, we still have that divergence in place, and it's worth keeping an eye on from a longer term perspective. And here we have what happened this week. Well, here we have a chart of the SPY, Exchange Traded Fund, on the top, and then on the bottom, I have a few of our advancing declining averages. The first indicator is the cumulative advanced decline line. We always like to keep an eye on that for divergences to give us a leading indication of what the next move in the market might be. And then we just have the advancing declining issues, the non-cumulative version, and the advancing declining volume, the non-cumulative version as well. And what we see is on the chart, we have a little bit of the SPY making these lower lows, but we also have on the advancing declining issues within the major indexes putting in a divergent high going back into mid-December through the new year. And that's played out. With this latest CPI report, we see a nice significant bounce in the markets breaking out from this divergence. So did the big money know that we're going to get a little bit of a bounce, that CPI report is going to be bullish and show maybe a slowdown in inflation? I don't know, but oftentimes we can get a leading indication of what the big money feels is going to happen next by just zoning in on what's going on with the advancing declining issues and the advancing declining volume within the major indexes. So this has predicted that bounce nicely. Then we have the percent of stocks within the S&P 500 trading above their 200-day moving average. And I always show these because they're great leading indicators. And we did see that happen here. We had a little bit of a negative divergence in the percent of stocks above their 200-day moving average going from mid-October into December. And as the SPY was hitting new highs, that divergence played out. We had a little bit of a slowdown, and then we have a pullback here. And when we look at the percent of stocks trading above their 50-day moving average in the SPY, we saw this consolidation that was happening. And I said a few weeks ago, whichever way this breaks is going to indicate the next move in the market. Well, it broke down to the downside, and we saw that as the SPY was hitting all-time highs, that it broke down to the downside, and we got a bit of a correction. It started bouncing back and forth below the 50-day moving average on the S&P 500. But now we have something that looks a little bit bullish. Historically, when the percent of stocks in the S&P 500 trading below their 50-day moving average gets to an extreme level below 30%, if it crosses above that 30% level, oftentimes we see large moves in the stock market. So we see that going back here. In 2023, we got extreme with the percent of stocks above their 30-day moving average. And what happened? It crossed above 30, and then it took off from about 440 and just ran. Big move right thereafter. Well, now we have the same thing transpire. We have the percent of stocks above the 50-day moving averages trading below 30 for quite some time. That just broke out above that level. Is that an indication of the stock market making a big move from here? We'll find out. It's worth keeping an eye on. There is a lot of bullish sentiment, as I pointed out earlier, with the new presidential administration coming into office and how that looks bullish for the outlook of stocks. But like I said, things are priced to perfection. So we need to monitor these things on a regular basis just so we can stay ahead of the game. But this could be an indication of a big move in equities. Then we have the QQQs, percent of stocks above their 200-day moving average. We had that same divergence that we saw in the SPY, and that led to a pullback as well. Not quite as significant, it doesn't look as what we saw in the S&P 500, but nonetheless, a pullback. Here we have the percent of stocks within the NASDAQ of their 50-day moving average. We had that same consolidation. We had that same breakdown from the lower end of that consolidation, and now we have a oversold condition where the percent of stocks above their 50-day moving average has reached an extreme level, and it's trying to break above that 30 level. Again, we'll keep an eye on that and see how that plays out. Next up, here we have the daily chart of the S&P 500. We did talk about that head and shoulders pattern and how it regained that neckline. And now we have a little bit of a downtrend that we had forming off of that recent pullback. And what's really great and exciting here is that we retested the 50-day moving average. And now today we broke above that 50-day moving average. And it looks like we closed just above that upper downtrend line. Let's keep an eye on that next week and see if that leads that we come back and retest these highs up around $600 per share. We'll watch that and keep an eye on it, but this is all constructive and worth celebration. We are back above the 50-day moving average at the close today. One more thing I like to point out and keep an eye on is the bullish percent index for the S&P 500. Typically, it is very bullish to have this up around the 70 level, extended, especially for extended period of times. Oftentimes, though, we get these pullbacks where it gets extreme and the bullish percent index goes again below that 30 level. And when it crosses above, we get a nice bullish move. We did have a nice correction here. We haven't reached a level where it's below 30 or an extreme level, but we are below the 50 level. And I'd like to see that get back above 50. I'm going to keep an eye on this. This again showed also a negative divergence. While the S&P 500 was hitting all-time highs, the bullish percent index also showed a negative divergence. And if you were aware of these things, if you're watching my videos, if you were subscribed to these videos, you would have been ahead of the game. I hope that was the case. Let's move forward and go into our stock sector analysis for the week ending January 17th. And we'll start off with our sector heat map. And we saw big moves this week in the financial sector, industrial sector, utility sector, real estate sector, and material sector, as well as the energy sector. Some of that was related to financials, have been putting in outstanding earnings so far this earnings season. And a lot of the other sectors, such as utilities and real estate, is because we're seeing a pullback in the 10-year treasury yields, and they are very interest rate sensitive. And if there's anything that would indicate a pause in the Federal Reserve raising interest rates or keeping them stagnant, typically we see some short-term moves in those interest rate sectors to the upside. If there's news that comes out that inflation is coming back and the Federal Reserve is planning to raise interest rates again, we'll probably see those sectors start to turn back down and have negative weeks. But the important thing to know is when you log into the member area of our website is that we do these sectors from a longer term momentum perspective so you can get a bigger picture of what's going on longer term and not these short term week to week fluctuations. So let's see, where has the money been moving as of late? Well, the first thing we notice is when we look at our ratio charts and we compare different sectors to the S&P 500 and other sectors to other sectors, the first thing we notice is that Bitcoin has been unusually strong. While the market has been correcting, Bitcoin has been holding up really, really well. There's a lot of money going into digital currencies, and this is worth keeping an eye on. That sector, digital currencies, has outperformed the stock market by leaps and bounds in 2024. And whether that happens in 2025 is yet to be seen, but there's a lot of optimism in the digital currency sector. We were also talking about the Magnificent Seven for the last few weeks and how there's a lot of money going into those big Magnificent Seven stocks, the Microsofts, the Googles, the Alphabets, the Nvidias. And we see a little bit of that playing out here where there's a little bit of weakness in those Magnificent Seven sectors compared to the S&P 500. Nothing significant, but it's worth keeping an eye on to see if this is something that's going to build a little bit more, if it's just a little bit of a pullback. The other thing that stands out is we've been monitoring the large cap growth sector versus the large cap value sector. And we noticed that growth was really outperforming, and it's partly because of that rotation of those Magnificent Seven names. But we do see also a little bit of that playback of a pullback into value as we've been correcting here in the market. That's normal because typically that leads. So when we saw back here in July and August, we saw that value was starting to lead before the market corrected, but we didn't see that same type of correction going into this recent pullback in the S&P 500. Mega caps versus the S&P 500. The mega caps are usually the Apples and the Amazons. those Magnificent Seven names, and we're seeing a little bit more of a correction in mega caps. There's a little bit of weakness in mega caps versus the overall market. Here's what's interesting is the equal weighted S&P 500 versus the regular S&P 500. We've been talking for a while about the power of those Magnificent Seven and how they take such a huge weighting up in these indexes of the S&P 500 and other indexes like the technology sector. Well, this week in this correction, we saw the equal weighted sector perform a little bit better than the S&P 500. So the pullback here shows the S&P 500 is made up predominantly of those Magnificent Sevens with a larger weighting. And we see that there's been a little bit of a value shift into the RSP. And also we have the risk on chart here, consumer discretionary versus consumer staples. Typically, when we see money rotating into consumer staples, it means it's a risk-off market. And when we see money rotating into consumer discretionary, it's consumers are doing well, and those stocks should do well, and that's a risk-on move. And we see going all the way back to September of last year, it's just been up, and away for consumer discretionary, and that has been a top-performing sector. It's worth keeping an eye on. If we start seeing a rotation into consumer staples, I would get a little bit more concerned, but we're not seeing it at this juncture. Let's go on sector by sector. First up, we have one of the stronger sectors in the market, the communications sector. Here it is displayed as a communications sector exchange traded fund. We see that holding up nicely. I drew a VWAP line in here going back to the pivot low in September of 2024. We saw a retest in that pullback to that VWAP level, but we haven't quite regained our 50-day moving average. We need to get above there, but the volume has not also been as good as it has been in some other sectors. I'd like to see a nice high volume push back above that 50-day moving average and a retest of these highs around 102. But all in all, this long-term trend is still intact. It just looks like a little healthy consolidation pullback here, and it should, as long as sentiment remains positive in the market, regain its upward momentum. Then we have the financial sector. We had a nice little channel coming in the financial sector, and it just recently, going into earnings, broke out of the lower trend line of this channel and came down and retested this VWAP I drew here off the lows of August 2024. Well, earnings season has been starting, and we talked about the FactSet earnings and how the financial sector has been outperforming with their earnings estimates. And we see this huge rebound bounce off of that news, and it's now back above its 50-day moving average. It's now retesting that trend line that it broke. Hopefully we can regain that and continue our upward move. We're not that far away from the highs, right around $51, $52 per share that we saw in the financial sector. And also, if you've been a member of ConquerWallStreet.com, you've been trading the financial sector exchange traded fund via our TrendSync Pro trading system. And you can see we've been long here since early, looks like 2025. We have a long signal that's currently positive. It is a winner so far. We haven't closed this position out, but it is getting close to overbought, and we should be closing that position out shortly. This system can dollar cost average into positions and usually has an average holding time of about 15 to 25 days. And it's performed greatly. I mean, you can see 80% of the trades in this trading system have been profitable. It has an awesome profit factor of 6.046%. I'm sorry, not percent. It has an average winning trade of 2.67% and an average holding time of 25 days. If you're not a member, please come check out this trading system. You get your email alerts every single day after the stock market closes, and it tells you whether to enter your positions the next day or close your positions the next day at the stock market open. It is ideal for busy investors that want to have highly profitable trading systems with a high historical winning percentage. With that out of the way, let's talk about the industrial sector exchange traded fund. This sector had the same channel we saw in the financial sector, but it has not quite regained its 50-day moving average. I did trade below its VWAP as well. It was not doing well for quite a while. We need to watch this. It does have a lower low put in and lower highs. So let's keep an eye on this, but we are still trading above our 200-day moving average. I really don't consider a sector completely broken until it starts trading on a regular basis below its 200-day moving average. Material sector. This is one sector that looks very broken. You see that we're getting a little bit of a bounce here. But we are below our 200-day moving average. The 50-day moving average is sloped downward and below the 200-day moving average. This is all coming out of this double top we saw back in October. And put this double top in, and it's just been down since then. It did try to put in a nice orderly channel to the downtrend, but it just really broke down and got destroyed in December. And we're just seeing like an oversold bounce is what it looks like here. We haven't even gotten up to our 50-day moving average yet. Keep an eye on this, but this needs to really constructively put in a series of higher highs and higher lows to really build some momentum. This chart does not look healthy. Utility sector. This is an interest rate sensitive sector. So this sector is going to be affected a lot by what we see with things like our CPI reports and what the Federal Reserve projects to do with interest rates. So this chart looks kind of sloppy. We have this broadening top forming here. Lower highs have been coming in. And we had this VWAP I drew from July of 2024. It broke down beneath that, and it's now retesting that. But we are significantly below our 50-day moving average, and the moving average is sloping down. This doesn't look constructive. We have gotten a little bit of a bounce in some of these sectors that are interest rate sensitive off of the CPI report. So, but I showed you the chart of the 10-year Treasury earlier, and until that looks constructive to the downside with rates, I don't really see these interest rate sectors as being bullish opportunities from a long-term perspective. Here we have technology sector. And we were talking about a double top here possible, and we were talking about the strength in the Magnificent Seven. Well, the technology sector ETF holds a lot of Magnificent Seven stocks in great proportion. So we're seeing a little bit of that MAGS pullback here on this chart. So watch the Magnificent Seven to see if we get a little bit of momentum in here, and the technology sector should improve and start taking out these all-time highs around $240 per share. Consumer staples, interest rate sensitive, 50-day moving average is sloping down. Chart looks ugly here. We are getting a little bit of a bounce, but look how far we are away from our 50-day and 200-day moving average. It's just been a really steep downtrend, and money is going out of this sector and into consumer discretionary. XLY, consumer discretionary, just talking about how great the sector is, and you see this broadening trend lines. It does have a healthy pullback. It came back to the 50-day moving average, retested below it a little bit, probably took out a whole bunch of stop loss orders there, and then bounced immediately off of that. It looks like we're going to push back up to these highs around $240 per share. Real estate, interest rate sensitive, ugly chart, double top pattern around $45 per share, and it just broke down from there. Same thing applies as to the other interest rate sectors like utilities. Let's watch the 10-year treasuries and see what the news is moving forward. When we have stability on interest rates, we can always revisit these sectors. Energy sector. This sector has been a hot mess, up and down in wild swings. Really, you can't constructively trade it when it's making these really violent moves between $84 and $100 per share. We need to see some constructive trend developing, and you really see it on the chart. See how the 50-day moving average just waves up and down below the 200-day moving average. This isn't constructive. This isn't really tradable from a long-term perspective. If you're a value investor, you might find some value opportunities to start dollar cost averaging into the sector. But at this point, it is an avoid for me. Gold sector, I am bullish gold long term. Gold usually goes through these periods of consolidation and then breaks out. You see a period of consolidation right here in early 2000, at the end of 2024, and we broke out. And you saw another period of consolidation from which we broke out. This looks like we're having that same period of consolidation, which may lead to a breakout some point into the future. Now let's move on to Bitcoin and digital currency analysis for the week ending January 17th. As always, I always like to start off with the Fear and Greed Index. The Fear and Greed Index has been up at these greed levels for quite some time. Week after week, it seems like it's always bouncing around 75, 78, 74 last week. We ticked back up 1 point on the Fear and Greed. Whenever we are in greed level, you have to be careful of a knee-jerk reaction to the downside should something happen in these markets. And as you know, Bitcoin, Ethereum, and a lot of these digital currencies are very volatile. So please keep your guard up and pay attention. These currencies trade 24 hours a day unless you're trading an exchange-traded fund. Flow of assets, CoinShares flow of assets report. I always like to take a look at this and see where the money is moving. And we see that reemergence of funds flowing into Bitcoin. But what is unusual is money seems to be moving out of Ethereum. We saw a lot of money moving into Ethereum in the month of December, and now it looks like that money is coming back out of it. But still strong is Solana and XRP. I am an XRP bull. I own a lot of XRP. And if you do also, you've done quite well over the last couple of months. You've seen your position grow in value substantially. And Solana, there's a speculation that a lot of money that was bullish for Ethereum is starting to rotate into Solana's ecosystem. We'll keep an eye on that. I may even develop a mechanical trading systems for Solana. If there is interest in that, drop something in the comments below. Let me know if you'd like to see a mechanical trading system for Solana or XRP Ripple. I'd love to hear from you on what your thoughts are. Here we have the holdings greater than 155 day, the long-term holder supply. And usually what we see is we see holders as the price is going up in Bitcoin, you see the holders starting to unload their tokens and sell them into the uptrend, take profits. Well, we're seeing that happen here in January. We're seeing the price of Bitcoin go up and the long-term holder supply is being sold into this move. Now, whether or not this is going to enter into a pullback consolidation, you see the pullback that happened here in July of 2021 as they were selling into the uptrend. The pullback came in and all those long-term holders bought that dip. So we have to be on guard if those long-term holders are correct and history repeats itself. At some point, this uptrend is going to have a correction. And that's what's nice about our mechanical trading systems. We've already taken profits in Bitcoin and we're running with 50% of our original position. Here we have exchange reserves, the amount of Bitcoin on cryptocurrency exchanges. And this goes back to December of 2024, but you see the amount of tokens on the exchanges is declining. That is bullish. That means that people want to hodl this stuff. They want to hold on to their digital currency. They want to hold on to their Bitcoin. And when you see money flowing onto the exchanges, you should start to be concerned more of a correction is coming. Here we have spot Bitcoin exchange traded fund flows. And we see over the last couple of days, there's been money pouring back into the exchange traded funds. We did have a couple of days where money was coming out, a little bit of profit taking, but money looks to be coming back into those funds. And then we also have the exchange inflows and outflows. And it looks like predominantly, this is very bullish, the majority of Bitcoin is coming off of the exchanges, and that bodes well for the long-term price of Bitcoin as well. So what does all this mean? We are having an awesome week in Bitcoin, 10% move this week alone. At the time of this video, it was up 10.79% on the week. Congratulations. We do have this area of consolidation that was forming in here. It looks very similar to what we saw back to the most of 2024. Will this break out to new all-time highs above $108 per share? I don't know. We are going to run the risk that we have this long extended consolidation period that we saw from most of 2024 through 2025. Maybe we go sideways and we come and touch this trend line here around $90,000 to $100,000. We just remain range bound for quite some time. I don't know. We need to keep an eye on this. This is a volatile asset, as I've said before, and it is prone to significant corrections. Here we see that cup and handle pattern I've been pointing out for a few weeks in the breakout. And something that supports the possibility of a correction is the fact that the RSI is divergent. So we have a divergent RSI and we have Bitcoin hitting higher highs. These don't always play out, but you should be aware of the possibility. Here we have a daily chart of Bitcoin paired with the US dollar. And we do have a little bit of a breakout of this downtrend channel. This is bullish. And this bodes well for a retest of this $108 per token level that we see on the chart. That would be an all-time high. Can it break out from there? I do not know. but we have a nice uptrend in the 50-day moving average. We have a nice extension from the 200-day moving average. There is a possibility if we do break down, we do have this trend line going all the way back to September of 2024 that would put Bitcoin at a price of $84,000, $85,000 per token, and it would still be in a dominant long-term uptrend. Moving on to Ethereum, we see today a bit of money flowing back into Ethereum, but for the most part, it hasn't really been very leading as to whether that money is predominantly coming into or out of Ethereum exchange traded funds. Here we have the Ethereum spot inflows and outflows on exchanges. It looks like today there's a large inflow of Ethereum onto exchanges. I don't know if that's going to continue. Typically, one day does not mean you're going to get a pullback in Ethereum. Predominantly for most of the month, we see Ethereum coming off of the exchanges. And here we have our weekly chart of Ethereum. As I've been pointing out, this long consolidation pattern that we have going on here between the high of 48.67 and this low right around $1,500 per token in Ethereum. And now it's consolidating. And whichever way this breaks is probably going to indicate the next direction for Ethereum. We do see this sloppy up and down 50-day moving average, which is currently sloping up. That is bullish. It is currently trading above the 50-week moving average. That is also bullish, and is currently above its 200-week moving average, also bullish. So if Bitcoin breaks out the new highs, I think that's bullish for most digital currencies. Bitcoin is a leader, and altcoins usually follow what Bitcoin does. So keep an eye on that. Here's a daily chart of Bitcoin. And you see that sloppy move of the 50-day moving average going back and forth. It is very range bound in between that very large range of 40 that I pointed out before, of 4,800 down to 1,500. You can't quite see the full range on the daily chart, but it is just violent moves up and down between those two price points. And also XRP Ripple. We have a lot of bullish things happening for XRP Ripple. There's talk that the SEC may not have filed their appeal in time for the litigation that they have against Ripple. There's also a lot of talk and chatter about central bank digital currencies and XRP being a leader in that space. Well, here's what that all means. It means that in November, this was trading at 60 cents, and it now means that Ethereum is up over $3 per token. If you've been a long-term bull on Ethereum, well, your weight has paid in great dividends. And I'd love to have a mechanical trading system on XRP Ripple, but it's really hard to do because it's been in such a sideways consolidation pattern for so long. And if there is no trend, there is no mechanical trading system. So hopefully this trend continues and we can build a system for all of you fans of Conquer Wall Street that would trade XRP profitably and make it easy for you to do so. And that's all I have for you today, folks. As always, check us out at conquerwallstreet.com. Stay sharp and prosper. Trader Razor out.